Well, happy Monday to each and every single one of you. Hope you had a good weekend, enjoyed a little football if you like that sort of thing, or if not, got your Christmas shopping done. I know Brent and I are still, you still have time to get us presents. Appreciate you being here today in our Straddles and Strangles webcast. I'm Connie Hill. We get some big moves in the markets at times, and Straddles and Strangles are strategies that maybe give us an opportunity to take advantage of those situations. We're going to talk about that a little bit deeper here today when we go back and review one of our trades that we did that we got a really big move on, but it still didn't produce what we liked. Okay, so we're going to take a look at that and talk about, well, what do you do? All right. I am joined in the chat by Brent Morris. I'm glad Brent's here. He teaches additional advanced option strategies beyond straddles and strangles. And I believe that's on a Thursday webcast. Brent, you can put in the time there when that occurs. But he's here in the chat to help answer any questions that you might have. He's very well versed in all the strategies that we talk about here and beyond. Okay. Hope you're following us on X. I'm Connie Hill CS. Brent is Brent Moore CS, and we'll post educational content out into our X account as we see things that surface that we think you might find interesting. We like to share that information with you. All right. Let's go to our disclosures, and then we'll get into our agenda here today. Options carry a high level of risk and are not suitable for all investors. What we talk about today is intended for information and education. Don't consider it a recommendation. We will be using the Paper Money software application. It is a good educational tool. It's good to practice in it and practice strategies and different rules in Paper Money. And that's what we're going to use here today. Investing involves risk, including the loss of principal. There is no guarantee that an execution of a stop order will be at or near the stop price. Past performance is no guarantee of future results. All right. Want to make you aware of 3 events coming up, our next 3 major events. So Miami, Dallas, starting the new year in Dallas, and then Bellevue in Washington. So typically we'll pick spots to go to that have a lot of Schwab accounts. Hopefully it makes it easy for them to get in and see us, or hopefully if it's not something near you, then maybe you pick a good place that you wouldn't mind visiting for a day or two so that you can experience these events. All right. Typically we take a look at what the market is doing, right? See what we have going on, and then discuss maybe what strategy that we're going to go into today before we get to our example. So let's hop over to, let me get this in a better spot. Take a look at our markets. And I've actually got up here I've got 2 years because we're going to use that a little bit later. Let me switch it here just for our recent, what we're going to take a look at here with the S&P. And I've got a, kind of simplified chart here. And you guys know we've been seeing this turning up in the market, and then recently a little bit of sideways motion, probably the best way to say it, right? Interesting, we had a nice peak up here that occurred in October, and the market hasn't been back to it. Okay, that happened in October, and so some might be seeing possibly, we'll see what happens here, a forming head and shoulders pattern, right? It's a reversal pattern. It's a pattern that says, oh, market might be running into weakness. So here's the first shoulder. You look at a person head on, you see their, oops, that's really their head. Okay. And then over here, possibly maybe the second shoulder's forming here. And then if you're looking at this and you're like, well, how do you trade a head and shoulders pattern? We really wait for the price to break through support to let us know that it's going to complete that pattern. Okay. We don't have a completion of that pattern yet, and it might not happen. Okay. We just want to be aware that there's a possibility that it could occur, because 6,500 has been a pretty strong area of support for the S&P. And then if we say, okay, what's been going on maybe the last week, a little bit of sideways activity. Now, typically, if you go back historically and you look at December is usually a pretty good month in the market, right? We have the Santa Claus rally. That's not yet. That's when we get down to the holidays. But overall, yeah, December is a decent month, but it's never guaranteed that it's going to be, right? If we look at here, let me get rid of these drawings, and I'm going to come down and say, okay, where was December 1st? December 1st is right here. No, that's the second. Here's our first. If we say, well, what's happened so far in December? I would say, well, it's gone up slightly, but not a whole lot yet, right? NASDAQ looking similar, although I would say that the S&P's been a little bit stronger than the NASDAQ lately. Again, we could see possible head and shoulders formation, head being up here, first shoulder being here. Now, the second shoulder possibly is here, what's forming right now, say in the month of December. Again, we don't have confirmation that it is going to reverse, but we just kind of watch, right? We trade what we see. We don't say, oh, it's probably going to do this. We say, okay, show me evidence. That's what you're doing. Then we adjust to that when we see price confirm that. What's the volatility doing? Well, let's pull it up. Kind of back down in a shorter range for us, isn't it? Or a smaller volatility range. Looks like right now it's at 16 and some change. And it's kind of popped up here a little bit today after, the last week falling down just kind of into some lower volatility ranges. It doesn't mean there's no volatility in the market, but when it creeps up and it's getting above 20 and 22, 24, then we know there's a lot of fearfulness in the marketplace. Seeing a lot more people buying puts for possible protection and possible bearish type scenarios. So we're not really seeing that yet, but could something develop? Obviously, of course. So that's why we take a look at it every once in a while, right? So that you see that. Want to go over to the chat. Somebody was saying I was just looking here. Somebody said they had a really, well, Muriel, I think it is, Muriel Corey, was wondering about Netflix. I don't know about that one. Somebody was saying, I was thinking somebody said, I made a bunch of money on a certain stock that moved, and I think it was Warner Brothers, and now I can't find the comment. But with the Netflix and Warner Brothers news last week, that actually would have been a good time to use either a straddle or a strangle possibility there. Now we're not in heavy earnings season right now, although when we are in heavy earnings season, straddles and strangles can make a lot of sense. We're not really at that point yet, but let's take a look at some things that have earnings this week, okay? Our first stock that we're going to look at is Oracle. And if we're going to step through a process and just try to decide, hey, should we do a straddle or a strangle, long or short on Oracle? Let's go look at its history. So we have up here a 2-year chart because I wanted to capture, a little bit of some of the earnings, kind of get a little bit more history. Hey, is this a big mover earnings or not? And it is, tends to be. All right, and so I went back here. This is let's go back even a little further here. Let's see, this one right here, that's last December. And if you can barely see it here far on the left side, you can see here was Oracle before they announced earnings, and the first day they started trading after the news, we see a bit of a gap. So we want to look for gaps. We want to look for big candles. That gives us an idea if it's moving big over those types of announcements or not. Okay, so decent size move there. Next earnings didn't move a whole lot. If I highlight this area here, you're going to look at that and go, man, it really didn't move a whole lot, that earnings. Interesting. Maybe that could have been an opportunity for a short straddle or strangle versus a long one. It's the long ones when we go into those if we're really expecting a big move. Okay, next earnings, what happened here? It was here about 177 before they announced. After they announced, gap up, continuing running that day into the next day. So it had a pretty big move over those 2 days. Okay. So, all right, kind of fits the mold there. All right, last earnings announcement. And man, it just seemed like this was yesterday, but Oracle was sitting here about 240, huge gap up, right? It gapped up here. It went the next day up to 345. It lost a lot of that since then, right? There was a big expectation about how AI was going to impact Oracle and how they were going to use it, and people were all excited about it. Popped clear up there, but then just kind of over the last 2.5 months, it's just kind of fizzled out. And so this gap was filled. Not all gaps are filled, but we look for that to happen. And if the gap gets filled, then sometimes the technical trader might say, okay, we don't need to worry about filling in this gap anymore because it did it back here in November, pretty much filled in that gap. All right. What's expected right now with Oracle? Let's maybe just zoom in here a little bit. They will announce the 10th after the market. So that's Wednesday afternoon. So probably not a lot of news is going to come out until then. And then we have what's called the market maker move. And I share this formula with you pretty much every week because we use it so much. And let me just copy that, put that out here. For those of you that are in the class live, I just put that in the chat. Remember, scripts that we share with you aren't guaranteed as to accuracy or timing. Okay. Those of you that are listening to this on the recording, let me just put up a quick text box. I'm going to pop it in there. Here is that URL. And remember to use it. This is a more advanced class, so I assume a lot of you have started using scripts by now. But just as a reminder, to use it, go to Setup, Open Shared Item, and then you post in there, starting from on this one, the exclamation point. There's 9 characters here. They are cap sensitive. So this capital SUX, yep, you got to make sure you do it all capitals. If you're here live, you can just copy that. So just be aware of the tense there. Go ahead to hit preview. Make sure it's a name you like. I call mine MMM on the chart. Money or market maker move. What is the market maker move? It's basically what is priced into the at the money options for an expectation of movement for the news. It doesn't have to be earnings. It could be some other big announcement where somebody mentioned in the chat they did Warner Brothers, which had an enormous move, right? When the news broke that Netflix was going to be the winner in that scenario, right? Merging and buying up Warner Brothers content. And so, yeah, it had a pretty decent sized move. Okay. A couple quick questions here to answer. Somebody was wondering what was the exact trade and what was the entry. Okay, that's probably to somebody in our audience here, what you're wanting to know what that was. That looks like also in the chat that we have a survey, and you guys know from time to time we'll give you a survey. All right. Seems like this class has had quite a few surveys. In any case, we always appreciate your feedback. We appreciate the information you share with us. It's really easy. I like easy surveys. Pop, fill in the radio button on a scale of 1 to 10, what your feelings are. Okay. And then there's a couple questions if you want to respond to. We're always happy to see what your input might be. And even if you want to communicate something with me, I say that's a great place to do it because there's limitations on how you can contact Brent and I throughout the week, right? But one of the great ways is through this survey. We look at it, we read every word that you submit. Our managers read every word you submit. So if you might, just go ahead, click on that link, let it sit in the background. As it sits in the background, just know when we're finished with our class, you can go fill out the survey. If we close the class, you haven't clicked on the link, then you don't have that opportunity. We love to have your feedback. And we thank you, every one of you, who will submit a survey for us. All right. Somebody says, when do you use straddles and strangles? Did I miss that information? Straddles and strangles are basically taking a trade, whether we're going to go both, could it go up or could it go down? and trying to take advantage of it. You know, it's typically, if we're going to buy a straddle or a strangle, it's because we expect a big move. Now, right here, this market maker move at 10.1%, I would say that's a pretty big move. I mean, if you think about how much maybe a stock might move in a year, you know, and if a stock's up, you know, a growth stock's up, say 50% in a year, man, that's pretty cool, right? But to have it be 10% just in for one event, a possibility of that. That's why some people like to trade this strategy. Now, one thing I really like to stress here is that it's a speculative trade, meaning it's a lower possibility trade, and we've got some Greeks working against us sometimes. We're going long, beta decay and implied volatility can work against it when we're buyers of options. When we're sellers of options, sometimes that might work to our favor. So we're going to get into that when we look out on the option chain here. Let's see. Somebody wants to know how we did on the CrowdStrike trade. That was actually in our other class, so we're not going to review it here, but we will review that in our option strategies class. What we're going to look at here is the Marvell trade that we did last week. Okay, Marvell. Let's come in here, just kind of take a look at the chart, and then we're going to get into the nitty-gritty details. With these kinds of strategies, you're often sometimes you're making a decision fairly quickly, and it's after that news comes out. Let's maybe change this to maybe say a 3-month view. On Marvell, we knew they had earnings coming up here. Their earnings were on the 2nd of December, which was the next day, so on a Tuesday. So they announced after the market closed. So we went ahead. We're not looking for a technical setup here. We're not looking for a bounce or a breakout or anything. We're doing the trade because of the expected movement in this stock. This one was expected to move about 10%. Okay, 10%, like I said, is a pretty big move. And on this one, so this was the day they announced that evening, and the next day, that was a pretty large gap up. Can you see that? From where it closed here at 92.89, the next day it opened at $100.04. So yeah, that's about a 10% move there. Now, what happens after the news comes out? Okay, hope some of you are getting to the point that you're able to answer some of these questions to yourself. What do we expect once the news comes out? We expect the implied volatility to come crushing out. It's kind of like the balloon pops. And that part of the option premium that is devoted to implied volatility, because the news has comes out, it comes crushing out of our options. So we might have a call and a put, and it comes crashing out of basically all the options in the option chain. So on Marvell, this is an interesting thing. I'm going to go into a shorter chart here to kind of show you that. And we'll talk about time frames there as well. See ya. We'll talk about this with this new trade. On this one, it's interesting to see. So it got that big move the first day. Is it guaranteed to stay there? Well, nothing's ever guaranteed. You know, sometimes the bottom of the gap will act as support. Bottom of the gap's down there about 95-ish, which is a lot different than, you know, up above 100. That's $5 back, right? So even though it might go to there at some point, it's never guaranteed. And did the bottom of the gap hold support? It looks like it did until today. Okay. So what did we do? The night the news came out, which was Tuesday night, I went out and looked to just see what the market's initial reaction was. Now, what we're going to do is we're going to move into a time frame here. Let's see if I created this. We're going to do a 5-day, 15-minute chart. Actually, you can do 5-day, 5-minute. Does that take us back enough? December 1st, when we got in. This does take us back far enough. All right. let's kind of maybe move over here. Since they announced the news Tuesday night, what I've got here is the gray shaded area. The gray shaded area is our extended market movement. Okay. So once the market closed and the news comes out, and then the next morning before the market actually opens, we can see what kind of trading activity went on here. Let's come back over here. So I want you to see, look what happened in after hours. Okay, so the stock closes there about 92.90. Initially, look at that, was a pretty decent drop. So the initial kind of boot kick reaction, right, was to the downside. And then you can see here, because we've got it in a 5-minute chart, you can see the actual, 5-minute increments. What did the candle look like? What did the candle look like? And so then after they maybe started reviewing the numbers a little bit more, ran clear up to 108. So it did get the big move that was priced in there, which is like, great. That's what we saw being priced into the move. And then as the trading hours wore on, what happened? Kind of settled down a little bit. It didn't settle down to where it was previously, but it didn't keep these highs. It didn't keep this low. Kind of settled maybe up in a little bit of a higher range. And then come Wednesday morning, I'm going to kind of zoom in here. Let's show you what things looked like Wednesday morning. Wednesday morning, so we're in the black area, and this is our candle that starts right at, mine is at 7:30 because I'm in the Mountain Time Zone, and so I have my clock set to the Mountain Time Zone. If you're on the East Coast, that would be 9:30 for you, right after the opening bell. So initially, it looks like, okay, it gapped. It gapped from where it had been previously in the pre-market trading. Gapped down a little bit, was a decent candle down, ran up. So lots of volatility in the first few minutes after the market opens. And then what happened was it stayed to the upside, but it looked like it was kind of fading through here. So right off the bat, what we did, when we saw what direction that it looked like the call, or our call was going to be the winning trade, we closed our put. We said, let's get out of it whatever we can right away. And so what I did is I went in and we adjusted our stop loss. And let's go to the monitor tab. And we're going to go here to our account statement, like you can see. So when we got into the trade, we paid $9.95 for it, so almost $10. And we're really focusing on the trade history here. Right at 7:31, when the news was out and the market still was making, its movements, it was determined, probably the put is not going to have a lot of value here. Let's get what we can get out of it. And so we put in a stop here about $3, right? If it was less than about half of what it was to get into it, let's go ahead, let's get stopped out. We got filled at $1.45. So we salvaged a little bit out of it, okay? But then the price kind of started to pull back a bit. And it wasn't staying up in the range that it was previously. So at 8:49, so about an hour and 9 minutes after the market opened, we went ahead and said, we're losing money in the call now. It's not worth as much as it had been. And so we went ahead and closed it. In these kind of trades, you're looking for the big move. And sometimes you have to get on it quickly for those shorter time frames. Now, we bought out to December 19th. We didn't want to box ourselves in a corner. We wanted to give ourselves a little bit of time. But with that kind of move and seeing it kind of pull back pretty quickly here, we went ahead and got out. Here's the 8:50 candle, and we got out at like 8:49. So we kind of got in or out on the end of this candle. And then rolled in, or this candle here is the 8:50 candle. So the very end of this candle and here. And then it looks like it continued to drop a little bit that minute, but then it just kind of stayed down here in a lower area. And when it's down in that lower area, you kind of feel like, okay, I guess it wasn't going to stay up there if you are wanting to make an initial call on it. Now, was that the best place to get out? We never know if it's the best place to get out. But if we can get some money out of the trade, then sometimes we're happy to do that. If we want to minimize our loss in the trade, sometimes we're happy to do that. So on this particular trade, we bought it for $9.95, as I told you. What we sold the call and the put for, some to $8.10. So we lost on that particular trade $1.85. If I go back to those numbers, you can see that here if you kind of go through the math there. So yeah, we did lose on that trade a little bit. And yet, man, we had a big move. And that's one of the reasons that I like to stress to you that it's a trade of speculation. It may not be one of your strategies that you like to do all the time. It's not necessarily a high probability trade per se. And had we held on to it over the week, well, continuing last week, down arrow or down candle, yeah, it would not have been in a very profitable situation. All right, let me see what your specific questions are now. Brent, thank you for answering some of those questions out there. Sia says, is there a specific time and delta and time frame to be used for straddle or strangle? You can experiment with different time frames, which is what we're going to do here. Sometimes you'll go out a little bit out of the money for the long legs, and on the short legs, we're trying to capture that implied volatility that's going to come crushing out. And so on that, typically we'll say, well, where is the implied volatility really high? So let's go ahead. I told you we're going to take a look at Oracle as our first trade here. And on Oracle, backing up, let me back up a little bit here, okay? Because I want you to see where it was last earnings and where it's back down to right now, okay? So it really did have a major pullback after the news had kind of settled after their earnings. That's why sometimes traders don't buy their long legs out really far, because they're expecting maybe whatever the move it makes that it'll continue moving that direction, and you want the flexibility to let the long leg run a little bit. But if it doesn't, we don't want to be holding on to it when it's just time decay, eating away at it. Okay. Let's see. What would be the ideal outcome? What would it have looked like, says P.L. Anderson. What would have the ideal outcome look like? Well, we don't usually get ideal. Okay. Ideal would have been to win on both sides, one on the long call and one on the long put. That would have been ideal, right? We don't always get ideal. However, that might be something worth going back and looking at. Had we held on and the value, well, we're looking at Oracle here, but if the value maybe had a really big swing, that maybe we caught a high peak when the call was up, and then maybe it sells off, and you can gain value in the put that you're holding, but we just never know what way it's going. And so many times traders make that initial decision based on the initial move that the stock might make. Okay. All right. Let's get to this. Just making sure I'm catching those questions. I think between Brent and myself, we've got you covered here. Again, quick reminder, there is a survey out in the chat. Okay, on our Oracle, let's go to the trade tab. And I'm going to kind of collapse things here a little bit so we can see. Oracle trades a lot, has a lot of activity, already traded over 10 million shares today. This is a US company, a finance company. In fact, I used to work in that world of software for big organizations, and Oracle had a period of time they went around merging and eating up and basically buying out those companies to be kind of like have a lot available of software that maybe you could choose from. Their company could help you out. And anyway, all right, look what implied volatility is looking like for the options that expire this week, because earnings comes out in a couple days here. 130%. What does that mean to us? Well, what it means is that the options that are priced there are really expensive, which means we really need a really big move. So sometimes people might want to sell the options there and try to take advantage of that implied volatility and have it come crushing out. Now, in the case of what we were looking at here, well, let me one other point here. As we go down to the ones that expire the next week, that happen to be the monthlies, it's not quite as high, but it still is kind of high. But you can see a 40% difference. So the volatility that's priced in the at the money options, 40% is really a big deal. Okay, it is a large amount. And then we get down to 90 the next week out, 75 the next week out. And then you can see out here in the monthlies, then kind of the normal, okay, it looks like it's 60 something or 50 something. So right now, yeah, those prices are really quite elevated. Now, what we're going to do here is very speculative. I can't stress that enough. But some good premium could be made here. This is kind of an expensive stock, a $200 stock. So this particular trade might not fit everybody's portfolio, okay? A lot of the stocks that are announcing this week are a little bit more expensive stocks, the ones that typically move a lot, which Oracle, we saw its history has a tendency to move. All right, right now the stock is at 218, almost 219. So what's going to be our at the money? Is our at the money going to be 220 or 217? I think it's going to be our 220 is going to be like $1.10 away, and this one's going to be like $1.40, 50 away. Okay, so 220 is going to be our at the money, and so typically a lot of implied volatility is priced at the money because there's quite a bit of time value there, isn't there? You go deeper into the money, you have more intrinsic value and less extrinsic value. But maybe from a selling perspective, maybe somebody wants to sell where there is a lot of premium and a lot of implied volatility. Now, the options are pretty juicy. I'm going to say pretty juicy here, right? We're expecting a market maker move of $22. So this market maker move that's in yellow, this is really just mapped out with that script. It just kind of maps it out, shows you where the move is expected to go, where that 10% basically makes it to. Okay. So here we're going to do a short straddle. And the idea here is that we want to quickly take advantage of implied volatility come crushing out. Now, let me ask you, suppose implied volatility came crushing out after the announcement is made. Let me just go back and review. I think it's after the market. Yeah, after the market on Wednesday. So going to be midweek. When we really can see what happens with it is going to be after the market on the 10th and before the market on the 11th. Okay, so a little bit later in the week. You want to, for this type of trade, you want to make sure that you are available, if you can be, to kind of see what's going on. If we were to, in this case, sell the 220 put, that's $12.25. That's a lot of premium. How much of that premium would you personally be satisfied to receive if implied volatility dropped, say on this put, after the news is out and you're looking at it on Thursday morning? If it is at 30% of that, would you be happy? What's 30% of 12? Maybe about $4. Some people might be. Some people might want more than that. But one thing we can do is we can go ahead, we can put some orders in and say, if we get a portion of that on the next day, we might be happy campers to just jump out. So we're going to put in an exit order right now as we get into the trade. Okay, so on that put, and actually, some of you started answering that question for me. Thank you very much. How much would you personally be satisfied with? See, it says maybe 20 to 50%. You might be satisfied with 20 to 50%, meaning you're not planning, even though the premium is really big here, you're not planning to get all of it. Let me bring over this little calculator guy. And if we have 12.25, what if we got 25% of it? Okay, if we got 25% of it, 75% would be left. Okay, let's multiply that by 0.75. That would be $9.18. If we took the difference in that, that's getting pretty close to about $3, right? Or yeah, $3 from $12 to $9. Some people might be really pretty happy with that and be happy and content to get out. So this particular trade, we're going to work on the basis of implied volatility crushing out. We're happy to get a part of it, not all of it. We would be happy to go buy it back. If that went down to $9.18, we're going to be happy campers about it and move on. Okay. The only thing we're trying to capture at that point is implied volatility. Okay. So let's set it up. And I'm just going to make it a real note over here in my scratch pad. So we're going to do a first trigger sequential. We're going to create an opposite order. And that opposite order, we're saying we are willing to go buy this thing back at 918. We're going to do it as a limit order, or rather, we're going to put this in here. Yeah, we're going to put it in as, we're going to put it in as a limit order. We're going to make it good till canceled. And we're going to hope that this shrinks down to 918. Now, what if the market moves beyond that? Well, maybe we get filled at a better price. It's not guaranteed. A limit order says, hey, if you can fill me at 918 or better, do it. If better is $9, great. We'd be happy with, well, it's got to be at least 918. Say it's 950. Okay, maybe it fills us a little higher. That would be nice. We don't really know. Okay, but we're basically saying it's speculative. We want to capture implied volatility. So we're going to send this in. And let me say, this is not always the only time frame you can trade. We're going to experiment with different time frames in this class. This one, we're going to do the very short time frame looking for Thursday morning. So let's go ahead. We're going to put this in our straddles and strangles. And we're going to do the same thing on the 220 call. So very similar premium, 1140. We're going to click on that bid price. We're going to do a first trigger sequential, create an opposite order, go buy it back when, let's see on this one, happy. Let's just use the same, if we get 25% of it, we're happy to jump out. We have 30% or 25% of 1140. Multiply that by 0.75, then we'll say, great, we'll go buy this one back at 855. All right, so it's not like this particular one is necessarily like a home run type of trade. It's more, we're looking to get a little chunk, and that was actually 855, not 850. Let me get the right number in there. All right, see kind of questions you go on. Can we go to a lower delta if we don't want to be assigned the shares? Absolutely, Chris. If you wanted to go further out of the money, absolutely. And really the trade-off is less premium, which is fine, because you might be interested in that. You might say, yeah, let me go a little further out of the money if I feel a little more comfortable doing the short strangle. I feel a little bit more comfortable there. Bring in less premium. But you still probably want to put on some type of exit and say, if I can capture the target being not so much hitting a price on the stock, but the profit target of being implied volatility crushing out and not looking to get a ton of it, just looking to get like this chunk and out. Okay. So that would be two shorts. See, yes, one on the call, one on the put. Okay. And many times it might just go one way, and maybe say if the stock drops, maybe they disappoint, who knows, right? And it's the call that we end up having to buy back, and it's not going to be priced at 855. We might choose to sell it or buy it back at a different price just to get out of the trade, but this might be just the initial trade we're going to put in here. Okay, so we're going to make that good till canceled. We're going to hit confirm and send. We're going to send it to our straddles and strangles bucket. get that. Mark says, can you reserve the strike display to display to high to low, high on top versus as it is? And when you're saying high, I think you might be talking about strike prices. If you're talking about strike prices, the answer is no. This is just the typical layout of any auction chain you might look to. So there's, as far as I know, there's no changing that, just because it is the typical format that it's laid out in. Okay, and so yeah, we kind of start at the money, right? And you go out of the money on the calls, they get a little bit bigger. You get out of money on the puts, they actually are going a little bit smaller. Okay. All right, I think that was the main. Sia says, I would hold less than a week. I would take 20% in a heartbeat. Yeah, for kind of like, it's not an overnight trade because they don't announce until Tuesday night. But for a very short-term trade, some people might say, yeah, let's try it. What can we do with this? In terms of the delta, Chris wants to know about the delta. Oh, okay, we already answered that, going a little further out or further out of the money. Absolutely. All right, you guys, this is a trade. If you want to put it in your paper account and trade it with me, I think you will have a similar experience that I might have of saying, okay, what is the initial news? Do we think maybe the call's going to be the winner on this trade, or do we think the put's going to be the winner? Remember, we're selling both, so the short put's going to be the bullish trade, the short call's going to be the bearish trade. Okay, and then you might get an idea, but it's not guaranteed to be there the next morning. It might be, but it might totally change. So look at it the next morning as well. Or and even if you can't do it that night, don't worry about it. Just look at it in the morning before the market opens, so you get an idea. Okay, what does the market think right now? What is the latest trend of thought? Okay, want to take a quick little stop over here, and I want to go back to this particular window here. I hope all of you are subscribers to our Trader Talks channel. Man, it makes it so much easier to find our content when you are. When you're subscribed, this is kind of the layout that you're going to see. Now, there's a little YouTube-looking logo that's in blue on the bottom right of your screen. You click on that, that allows you to subscribe. Well, we've got kind of some different layouts for you to take a look at. Obviously, this is what our class is right now. What's coming up next, right? What are the upcoming streams? Well, right after us, Barb will be Barbara Armstrong will be teaching trading a smaller account, followed by James Boyd, trading with technical indicators. So it kind of gives you an idea, okay, yeah, this is what's coming up, and give you an idea if it's maybe something you want to take a look at or not. We have some bite-sized content that we're refreshing every single week with new videos. So we're going to see a couple new videos come in here this week. Last week was Mike and Kevin Horner. And you can see this is about a 5-minute video, and Kevin's is about a 3.5-minute video. Okay, so that's what bite-sized, right? You're not going to sit there all day. You're just going to learn a little concept in a short period of time. And then, of course, our playlists. And some of you love our playlists so that you can go down, say, look at past straddle strangle classes. Maybe you want to look at some of the other advanced option strategies, maybe that Brent Morse is teaching in his advanced option class. Absolutely, the playlist is the way to get there. All right, my time is up. Man, I appreciate you being here today. So just a few asks as a reminder. If you'll fill the survey out for us, we always appreciate your feedback. And I look through the chat there as well. If there's something that you sent in to me that I didn't quite see an answer, or Brent didn't quite answer, I'll go back and look at those because I like to answer those kind of questions as well. Sometimes I'll do that in my X account. Sometimes I can do that in our next class. All right. So the survey, follow Brent and I on X, Connie Hill CS, Brent Moore CS. And if you found this helpful today, go ahead and hit the like button on the way out. That allows others to be able to find the class. And the other thing is, we'll experiment with different ways to use straddles and strangles in this class. Today, we just focused on that short straddle with Oracle. All right, you guys, have a great rest of your day. I'll be seeing you out here in the chat sometime soon, I'm sure. Have a great week. We'll see you soon. Bye.